Hey there, everybody. Thank you for joining me. My name is David Bryson. Today we're going to continue our video series on foreclosure defenses. Today we're going to be focusing on defense number 2, which is entitled Truth in Lending Act Violations for Damages. In part 1, we covered the Truth in Lending Act defense that covers your extended 3-year right of rescission on the original mortgage or refinance loan. And it also applies to the original mortgage, and you can refer to that by searching on my video channel. But today we're going to jump right into this. In the background, we're going to include some nice nature video for you, because this is mainly going to be an audio offering. I don't have really any panels, just informational. So to help pass the time and enjoy, we're going to go ahead and start some nice Fijian blue sky, blue ocean videos here. Okay, so as I said, defense number 2, Truth in Lending Act Violations for Damages. So, Truth in Lending Act is also referred to as TILA or TILA. If you hear that, that's what it means, the Truth in Lending Act. This is basically a law that came from the Federal Reserve Board that protects borrowers from predatory practices of credit lenders. And it does empower the consumer to understand what kind of protections that you have under the Truth in Lending Act. So, Truth in Lending Act's purpose is to ensure the proper disclosure of credit. Violations of TILA give rise to strict liability, so there is no technical violation of TILA that does not create liability. The significant remedy available to consumers is that of rescission, as discussed in the previous chapter. Rescission means the entire mortgage transaction is unwound. All fees, closing costs, and down payment for the home is refunded to the homeowner. Again, the significant remedy available to consumers is that of rescission. As discussed in the previous chapter, previous video, rescission means the entire mortgage transaction is unwound, all fees, closing costs, and down payment for the home is refunded to the homeowner. Additionally, all principal and interest payments are also refunded to the homeowner, putting the homeowner in the position he or she would have been if the loan never occurred. Rescission is clearly an enormously powerful tool for foreclosure defense, so it is discussed the most here. When a lender violates Truth in Lending Act law in a manner that does not rise to rescission, the lender is still liable for damages under the Act. For example, if the finance charge is incorrect by $20 instead of the $35 required for rescission, the borrower can still obtain damages. Alternately, a violation in a purchase transaction yields damages under TILA if the finance charge is not understated by more than $100. TILA also outlines a series of disclosures that must be provided to the homeowner. A failure to provide these disclosures triggers liability under the Truth in Lending Act. Spotting Truth in Lending Act violations requires walking through the checklists provided at the end of this chapter. Each section of the Truth in Lending Act has its own rules and corresponding liability. Spotting a Truth in Lending Act violation takes time and patience, but as mentioned, can pay big dividends. As far as limitations, for mortgage purposes, Truth in Lending Act applies to loans on properties with 4 units or less, but includes transactions for individual condominium units, cooperative units, mobile homes, and trailers if used as a residence. It does not apply to business, commercial, agriculture, or organizational credit. Investment purchases are also excluded. The right to rescind only applies to transactions secured by the borrower's principal dwelling. If a loan is modified due to a consumer's delinquency to the consumer's delinquency or default, the lender need not provide new TILA disclosures. However, a consumer that is assuming a loan must be provided TILA disclosures. As far as potential recovery, a creditor who fails to comply with any requirement imposed under the Truth in Lending Act is liable in an amount equal to the sum of the following. 1, any actual damage sustained by such a person as a result of the failure, and 2, damages not less than $200 or greater than $2,000 if the home loan is not a home equity loan. Recovery is not cumulative, so the borrower is only able to recover for one set of damages, even if there are multiple disclosure failures. In addition to Truth in Lending Act damages, many states may also provide for recovery under state law. Strategy. It is well worth the time and energy to carefully review your loan documents for violations of Truth in Lending Act violations. It is well worth the time and energy to carefully review your loan documents for violations of the Truth in Lending Act. While the violations in this chapter will secure you a small amount of damages, your research may very well lead to damages that enable rescission. Truth in Lending Act rescission is detailed in the previous chapter, previous video, number 1. The applicable law or civil rule. Truth in Lending Act is located at 15 United States Code 1601. Truth in Lending Act is implemented by regulation according to the Board of Governors of the Federal Reserve System, the board. The board has issued several regulations, including Regulation Z, which implements Truth in Lending Act for homeowners. Regulation Z begins at 12 CFR 226. Supplement I to Regulation Z provides definitions and additional information on how Regulation Z is implemented. This is part of Regulation Z and is definitive as to Regulation Z's meaning and purpose. As far as elements of the law, any violation found in the previous chapter will create liability for the lender, as well as any violation found in the next 2 chapters. The violations discussed in this chapter allow for damages. The basic element of a Truth in Lending Act damages claim are as follows. 1, the property subject to the loan is used as the principal dwelling of the person to whom credit is extended. This must be the case. 2, secondly, it has not been 1 year since the loan's closing date or the loan is in foreclosure. And then 3, one of the following must apply. Subsection A disclosure was not provided to the borrower or not updated after the information became inaccurate or outdated before closing. These include the annual percentage rate, or APR, the finance charge, and an annual percentage rate, APR, must be more conspicuous than any other disclosure except the creditor's identity. The correct finance charge. The finance charge must be accurate within $100. The finance charge and annual percentage rate, or APR, must be more conspicuous than any other disclosure except the creditor's identity. So again, this is under the subsection A disclosure was not provided to the borrower or not updated after the information became inaccurate or outdated before closing. These include, again, total payments, the payment schedule, the amount financed. None of this stuff can be wrong. Disclosing the necessary information with respect to the notice of the right to rescind, the identity of the creditor, whether the loan has a variable rate, whether the loan has a demand feature, if the loan has a prepayment penalty, the fact of the fee for paying late, or rather the amount of the fee for paying late, the fact that the lender will have a security interest in property, a reference to the contract that tells borrowers where to look for information about non-payment, default, and rights to accelerate. A statement on whether assumption of the loan is possible. The total sale price, using that term, and a descriptive explanation such as the total price of your purchase on credit, including your down payment of X amount. An itemization of the amount financed that may be provided as the HUD-1 settlement statement. This document must be provided separately from every other form. The foregoing disclosures must be in writing in a form the consumer may keep. The disclosures must be grouped together, segregated from everything else, and not contain any information not related to the disclosures. Okay, so one of these following must apply. So we just covered under Section A that disclosure was not made to the borrower under any of these sub-points we just went through. So this also has to be an element of this violation, one of these three, either that, the disclosure was not provided, or B, a good faith estimate was not provided within 3 days of the loan application, or C, for variable rate loans, the booklet titled Consumer Handbook on Adjustable Rate Mortgages was not provided to the consumer within 3 days of the loan application. Also, disclose the loan program guidelines for any variable rate program that the consumer expresses an interest, including 1, the fact that the interest rate, payment, or term of the loan can change, the index or formula used in making the adjustments, an explanation of how the interest rate payment will be determined, including an explanation of how the index is adjusted, such as by the addition of a margin, a statement that the consumer should ask about the current margin value and current interest rate, the fact that the interest rate will be discounted, and a statement that the consumer should ask about the amount of the interest rate discount. 6, the frequency of interest rate and payment changes. 7, any rules relating to changes in the index, interest rate, payment amount, and outstanding loan balance, including, for example, an explanation of interest rate or payment limitations, negative amortization, and interest rate carryover. 8, at the option of the creditor, a historical example illustrating how payments would have been affected by interest rate changes, or an example using the maximum interest rate and maximum adjustment for the loan. An explanation of how the consumer may calculate the payments for the loan amount to be borrowed based on either A, the most recent payment shown in the historical example in paragraph B28A of this section, or B, the initial interest rate used to calculate the maximum interest rate and payment in paragraph B28B of this section. 10, the fact that the loan program contains a demand feature. 11, the type of information that will be provided in notices of adjustments and the timing of such notices. And 12, a statement that disclosure forms are available for the creditor's loan programs. And then the final element, where it says one of the following must apply. The final element is that any advertisement for the Truth in Lending Act loans must clearly and conspicuously disclose all of the following, if any of the following are used in an advertisement: the amount or percentage of any down payment, the number of payments or period of repayment, the amount of any payment, and the amount of any finance charge. So moving on to the Truth in Lending Act damages checklist. First, check to see if the following disclosures were provided to the consumer at closing: the APR, which is the annual percentage rate, which is a measure of the cost of credit expressed as a yearly rate that relates to the amount and timing of value received by the consumer to the amount and timing of payments made. The finance charge and APR must be more conspicuous than any other disclosure except the creditor's identity. Check to see if this is provided at closing. The correct finance charge. An error under $35 in a foreclosure action enables damages. An error in excess of $35 enables rescission. The finance charge and APR must be more conspicuous than any other disclosure except the creditor's identity. Going down to, again, checking to see if any of these disclosures are provided to the consumer at closing. The total payments, the payment schedule, the amount financed, disclosing the necessary information with respect to the notice of the right to rescind, the identity of the creditor, whether the loan has a variable rate, whether the loan has a demand feature, if the loan has a prepayment penalty, the amount of the fee for paying late, the fact that the lender will have a security interest in property, a reference to the contract that tells borrowers where to look for information about non-payment, default, and rights to accelerate, a statement on whether assumption of the loan is possible, the total sale price using that term, and a descriptive explanation such as the total price of your purchase on credit, including your down payment of X amount. An itemization of the amount financed that may be provided as the HUD-1 settlement statement. This document must be provided separately from any other form. And the foregoing disclosures must be in writing in a form the consumer may keep. The disclosures must be grouped together, segregated from everything else, and not contain any information not related to disclosures. That's an important point. They're saying that all of the foreclosing disclosures must be in writing in a form the consumer may keep. They must be grouped together, segregated from everything else. If you don't have that, there's been a violation. You can collect damages, and if the financing statement is off by $35, you are entitled to rescission. It's typically a 3-day right of rescission for most standard contracts, but in cases of mortgages and refinancing, they extend it to a 3-year right of rescission. Next on checklist, damages checklist. A good faith estimate was not provided within 3 days of the loan application. Next, for variable rate loans, the book titled Consumer Handbook on Adjustable Rate Mortgages, or otherwise known as CHARM, was not provided to the consumer within 3 days of the loan application. Under this heading, also disclose the loan program guidelines for any variable rate program that the consumer expresses an interest, including the fact that the interest rate, payment, or term of the loan can change, the index or formula used in making the adjustments, an explanation of how the interest rate and payment will be determined, including an explanation of how the index is adjusted, such as by the addition of a margin, a statement that the consumer should ask about the current margin value and current interest rate, the fact that the interest rate will be discounted, and a statement that the consumer should ask about the amount of the interest rate discount, the frequency of interest rate and payment changes, any rules relating to changes in the index, interest rate, payment amount, and outstanding loan balance, including, for example, an explanation of interest rate or payment limitations, negative amortization, and interest rate carryover. At the option of the creditor, a historical example illustrating how payments would have been affected by interest rate changes, or an example using the maximum interest rate and maximum adjustment for the loan. And then finally, or not finally, but next, an explanation of how the consumer may calculate the payments for the loan amounts to be borrowed based on either the most recent payment, shown in the historical example in paragraph B2, 8A of this section, or the initial interest rate used to calculate the maximum interest rate, and payment in paragraph B2, 8B of this section. Next, the fact that the loan program contains a demand feature. Again, this is disclosing the loan program guidelines for any variable rate program that the consumer expresses an interest in including these things. The fact that the loan program contains a demand feature, the type of information that will be provided in notices of adjustments and the timing of such notices, and a statement that disclosure forms are available for the creditor's other variable rate loan programs. And final checkpoint, any advertisement for Truth in Lending Act loans must clearly and conspicuously disclose all of the following if any of the following are used in an advertisement: the amount or percentage of any down payment, the number of payments, period of repayment, the amount of any payment, and the amount of any finance charge. As far as defenses, you can use any of the defenses from video number 1, defense number 1, which is called Truth in Lending Act Violations Enabling Rescission. Refer to that video number 1 to see the defenses or hear them. And as far as starter discovery, okay, so use the discovery in the previous chapter. You may wish to include a request for admission along these lines when disclosure is inaccurate or missing. Admit the lender did not provide state required disclosure here. Okay, so in discovery, that's basically where you begin to assess facts. Let's see here. So the defenses, we'll go back, we'll just use this. So use the defenses outlined in the previous chapter. Those are simple. Affirmative defenses, properly included as an affirmative defense and survives even when counterclaim dismissed. Add these affirmative defenses to your answer under the affirmative defenses section. Use paragraph numbers where indicated. So here's one defense. The mortgage and note are void for lack of compliance with the Truth in Lending Act, 15 United States Code 1601, Regulation Z, and 12 CFR 226.1. The other defense is, affirmative defense is, the defendant is entitled to and hereby exercises his or her right to rescind the loan transaction for lack of compliance with the Truth in Lending Act, 15 United States Code 1601, and 12 CFR 226.1. And as far as discovery, add these interrogatories to your request for interrogatory responses. This is what you send to the mortgage company or the lender. State the method of the finance charge. State the method that the finance charge was calculated. State each charge on the settlement statement that was included in the finance charge, and state each charge on the settlement statement that was not included in the finance charge. So basically, you're asking the lender to put down in writing, these fact-based answers to these questions that you have that will be used in the court case. So, okay. This looked like a fairly short defense here. So we'll end this video, and our next one will be defense number 3, which is entitled Home Ownership and Equity Protection Act, or HOEPA.